Well, welcome everyone to our first in a series of seminars where we're exploring the topic of inheritance tax and the impact that that might have on us. Our topic today is really entitled How to Die Tidily. In other words, what are all the things that you need to have organised, or what should you have organised before that time comes, so that your loved ones don't have to scrabble around, look for the things that they might not know where they are, what you should have in place to make sure everything is in good order, so that you don't leave a hole of trouble and pain behind you, as it were. Just a quick update on what's happening at Expert Wealth Management before we get into the meat and the bones of that. First of all, we've successfully moved back into the office. We're currently in the office twice a week. We're working from the home from the rest of the week. And also we're now starting to receive clients back in the office again. Obviously, all the relevant safety measures have been taken. So we're hoping to invite you all back into the office as soon as possible and as soon as you're ready. We're still doing meetings on Zoom if people prefer to do that, if they feel safer. But likewise, if you're happy to come in the office, then we're very looking forward to welcoming you with us. I'm going to get cracking into the topic today. We have sort of pre-recorded this just to make sure we get all the bits and pieces right. So I'm going to share my screen and crack on with that. If during the presentation you have any particular questions, please type them in the Q&A and we'll come back live afterwards and answer those the best we can. So thank you very much for joining us today. So I'll just start the presentation now.
Good afternoon, everyone, and thanks once again for joining us today. Welcome to today's session, How to Depart Tidily, where we will look at the basics of inheritance tax planning. This session is not intended to be a technical session, but inevitably some aspects might be, and there may be some jargon included for which we apologise in advance. Don't forget to use the chat facility for questions, and we'll do our very best to answer those at the end of today. Although often in the news, inheritance tax is not widely understood. That's worrying because it affects thousands of families every year. In our session today, we hope that will enable you to take the initiative. But please remember, this webinar has been prepared for purely educational purposes and nothing is intended to be personal financial advice. Please contact us to discuss estate planning, inheritance tax planning, or any other aspects of your financial planning that you're not sure about, and we'll do our very best to help you. If your estate has an inheritance or circumstances, but in the session today, we hope to set out some of your options in a bit more detail and help you to make an informed choice. Estate planning can be complicated, but it doesn't have to be. There are very simple things you can do to start taking some steps towards mitigating inheritance tax on your estate. If you need any help with that at all, please do contact us and we'll take care of it for you. So today's session, and remember this is one of two sessions, today's session we're going to discuss the basics of inheritance tax, the importance of having a valid will and powers of attorney. We're going to talk about allowances and exemptions from inheritance tax, how to make sure that money is in the right place at the right time. And we're going to talk about, briefly, towards the end, our ICE document, our in case of emergency document that we sent everybody recently and is available for download on our website should you wish to use it. If you thought inheritance tax was just for extremely wealthy people to worry about, you need to think again. Rising property prices and good stock market growth have meant many more estates than ever are likely to face inheritance tax bills. In fact, the amount of inheritance tax collected is expected to reach £6.9 billion by tax year 23-24, an increase of £1.5 billion in just 5 years. Inheritance tax is paid on the value of the assets that a person leaves behind when they die. It can also apply to some gifts that are made before someone dies. When you die, your estate is the assets you leave behind. If you are married or have a civil partner, then you can leave your entire estate to your spouse or partner free of inheritance tax. But if you want to leave some or all of your estate to family and friends, then it may be liable to inheritance tax. Not everyone is required to pay inheritance tax. For example, members of the armed forces killed on active service, or who die subsequently from injuries incurred. But if the value of your estate is worth more than $325,000, known as the nil rate band, then HMRC will expect you to pay inheritance tax at a rate of 40% on the total value of your assets over the nil rate band. Your estate can include your house, any other properties you own, any savings or investments, but remember, some types of pensions are excluded from your estate, although other investments such as individual savings accounts, investment bonds that aren't subject to trust, general investment accounts, etc., are taxable. Any other assets that you have, for instance, including life assurance policies in your name and things like that, will be included. How do you work out what your estate is worth? Well, after adding up all of your assets, your next step should be to subtract any outstanding debts, such as credit cards, loans, and mortgages. You can also deduct the value of some gifts you've made during your lifetime, charitable donations left in your will, and the reasonable costs of your funeral expenses. After calculating the potential value of your estate for inheritance tax purposes, you need to consider whether or not it's worth less than £325,000. If it is, then your estate isn't facing an inheritance tax bill right now. However, it's worth keeping an eye on the value of your assets, as any changes between now and when you die could mean that you will face an IHT bill at some point in the future when you die. If the estate is worth more than £325,000, then your nil rate band will be fully used up and the remainder of your estate will be subject to inheritance tax. Moving on to the residence nil rate band, this was introduced in 2015. The headlines that claimed it will give people a £1 million nil rate band do need closer scrutiny though. Inheritance tax is basically a problem for homeowners. After years of rising house prices, most people are now facing an inheritance tax liability on their estate, thanks to the increasing value of their home. What's more, the current nil rate band of £325,000 for inheritance tax is expected to remain frozen for some time. In 2015, acknowledging the inheritance tax problem faced by large numbers of homeowners, the government introduced an additional allowance, an additional inheritance tax allowance of up to £175,000 to apply to the family home in certain circumstances. However, even with this, forecasts show that HMRC's inheritance tax receipts are going to continue to rise. The residence nil rate band applies to the estates of people who die after the 6th of April 2017, and the home must be left to direct descendants, i.e. children or grandchildren. The allowance has been phased in and reached a maximum of £175,000 per person for deaths that occur after the 6th of April 2020, so an additional £350,000 per couple. Adding this to a couple's nil rate band is where the £1 million allowance comes from. Okay, so the intention is that married couples and civil partners can pass on assets worth £1 million, including the family home, without having to pay an inheritance tax at all. However, not everybody will benefit. The allowance will only apply where the person who has died owned a property that was at one time their home. It will also only apply if the property is being left to the deceased's direct descendants, as I said a moment ago, children or grandchildren. The residence nil rate band obviously doesn't help you if you don't own a property, and it also doesn't help anyone who does not have direct descendants or who wishes to leave their home to someone other than a direct descendant. Furthermore, anyone without a property worth at least £175,000 per person or £350,000 per couple will only partially benefit. And the residence nil rate band is reduced by a rate of £1 for every £2 by which the estate exceeds 2 million. This means that larger estates may not benefit. And finally, anyone who disposed of their property before 8th of July 2015, for example, because they were going into residential care or living with children, will not benefit from the new allowance at all. Moving on to couples, what about spousal transfers? The existing nil rate band works so that if the first spouse or civil partner passes to pass away, leaves their entire taxable estate to their surviving partner, then the estate of the second spouse can claim a total nil rate band of 650,000, double the individual nil rate band. So far, so good. In a similar way, the estate of the second spouse or civil partner to pass away will be entitled to claim double the residence nil rate band applicable in the year of the second death, where their partner's estate did not make such a claim. The maximum amount of any claim will still be limited to A, the greater of the allowance at the time of the second death, and B, the value of the home owned by the deceased person. The residence nil rate band has been flagged as allowing couples to claim £1 million of inheritance tax exemption. However, to do this, the following criteria have to be met. And perhaps this is repeating what we said earlier, but it's worth repeating in my view. One spouse must have passed away after the 6th of April 2020 when the £1 million maximum was reached. The surviving partner must own a home worth more than £350,000 when they die. They must leave their home to direct descendants, i.e. children or grandchildren, and their total estate must be worth less than £2 million. Likewise for their deceased spouse. A lasting power of attorney is the only way that someone can choose who they trust to manage their affairs if they lose mental capacity and aren't able to do so themselves. Without an LPA, family members may experience practical problems and financial hardship in supporting their loved ones at critical moments in their life. We often are asked what's most important, or what worries you about your money? And people will answer us with things like running out of money, or not being in control, or I worry about what happens if I need care. Sure, there are financial aspects to consider in all of those questions, but there's also anxiety questions to answer. Our role is to help people feel at ease around money, to feel confident, and to have peace of mind. And I've seen it many times in my career as a financial planner of people passing away without having, of people becoming mentally incapacitated. It happens an awful lot that as we age, we suffer from cognitive decline, and we're less inclined to wish to deal with our money and financial matters. Plus there are situations which we've seen where people will have accidents and are left mentally incapacitated and unable to look after their affairs. In some cases, people can be in the process of writing a lasting power of attorney, when dementia takes over and the LPA isn't done in time. In that situation, you can end up with the Court of Protection, which is, basically a public body, and dealing with the Court of Protection can be costly. especially if you need to, appoint deputies. That can, involve solicitor costs as well. So it's going to take time and cause stress. And we do encourage all our clients as often as we can to prepare lasting powers of attorney, because the benefits of an LPA outweigh, in our view, the time, cost and stress of not having an LPA later on. There's two types of lasting power of attorney: finance and property, and health and welfare. With a finance and property LPA, you can choose when it can be used and how. So, for example, you can continue doing things for yourself as you normally would. Your right to do so is protected. For instance, you might have to go into hospital, but want a family member or a friend to sort things out for you for a few weeks. You may choose to do some things yourself, but allow someone else to do other things. This can all be set out in advance. A health and welfare LPA only comes into effect if you lose mental capacity. It gives your next of kin or chosen attorneys legal powers they don't otherwise have over things like medical treatment and other lifestyle choices. In that way, your wishes are known and may be carried out. Now, you can do your own lasting power of attorney on the Office of the Public Guardian website. It's reasonably straightforward, minimal cost apart from the time for doing it. Or, of course, you can go to a solicitor, and many solicitors will do a package of wills and lasting powers of attorney for you. Depending, and the cost of that will depend on complexity. But these are important steps that you can take along the road to making sure that you depart tidily. What about writing a will? Writing a will allows you to have control over what happens to your property, money, and other belongings after you die. According to research, 60% of UK adults haven't made a will, and that increases to 72% among 35 to 54-year-olds. Again, this is something that we want all our clients to do. Again, it's relatively straightforward. Again, you can do it yourself. We would advise you not to do, will kits available from, places like the post office or WH Smith, and we'd advise you not to use unregulated will writers. We're always going to say to you to see a solicitor, and preferably someone that is STEP, that's Society of Trust and Estate Practitioners, qualified, to do this for you. There are plenty of things to consider when making a will, and here are some of the reasons why writing a will is a good idea. Controlling your estate, the main concern for most people when writing a will is to make sure their money and possessions are distributed in the way they prefer. It reduces stress for your next of kin. After the death of a loved one, the amount of bureaucracy and arrangements to be made can be overwhelming. Writing a will helps alleviate that problem. Avoid arguments. Your family and other beneficiaries will have your wishes clearly laid out, leaving less room for disputes over who should get what. And I will always say to my clients, remember, you don't necessarily have to treat everybody equally, but you should try and treat everybody fairly. And that will be a subjective thing that you will want to discuss amongst yourselves. To make provision for your children, if you have children under age 18, you can specify who you would like to become their guardian, rather than entrusting that decision to the courtroom. You can make your funeral requests clear. A will is also where you can set out the kind of funeral you'd like, from whether you prefer to be buried or cremated, as well as your choice of music. And I do remember from writing my will with our solicitors that Jane and I have some fairly eclectic things that we want to happen when we pass on. So yeah, I'm sure our children will be in for a whale of a time at that point. And of course, writing a will avoids the intestacy rules, which we'll look at in a minute. But basically, if you die without writing a will, your estate will be divided according to set rules rather than your intentions. Now, surely nobody would want that. A will enables you to reduce inheritance tax, because anything in your estate above 350,000 is liable for inheritance tax. So making arrangements in your will can ensure you don't pay more tax than you owe, because you can make certain arrangements through your will to do certain things. You can give to organisations and charities, for example. So it's not just people that can benefit from your will, but organisations, charities, charitable causes close to your heart can also benefit too. And you can protect your digital assets. This is increasingly important. Photographs, password protected documents and so forth. That just brings into play here as well the ICE document that we mentioned previously. And you can also care for your pets. Your will can include provisions for your pets, such as who should look after them. I remember a personal story many years ago. My father was actually a solicitor down in Surrey, and he had an old lady client whose name was Molly, I believe, if I remember correctly, and she had 32 cats in her house, and her entire estate, including the sale of the proceeds of the property when she died in Guildford, in a very nice residential road in Guildford, were left for the benefit of these 32 cats. And then thereafter, when they'd all gone, for one of the cat charities, I forget which one, but it was always a favourite story of my father's telling me about that back in the day. Okay, so in formal terms, if you die without writing a will, then you're considered to have died intestate. And what you leave behind becomes subject to intestacy laws. And I don't expect everybody to necessarily read this, but there is a flow chart of the laws of intestacy shown on the screen here. If there are no surviving relatives who can inherit under the rules of intestacy, then the estate passes to the Crown. This is known as bona vacantia. The Treasury solicitor is then responsible for dealing with the estate. The intestacy laws are designed to help decide who's entitled to your estate under the rules of inheritance. A significant disadvantage is that your estate may not pass to the people you want to benefit. For example, if you're married or have a civil partner, there's no guarantee your children or grandchildren would receive anything unless your estate is worth in excess of £270,000. If you're not married or in a civil partnership and your partner dies, you will not be automatically entitled to inherit anything. The same applies if your relationship to the deceased was that of a friend, carer, or relative by marriage. If you're unmarried and you have children, they will inherit the estate under the rules of intestacy. This underlines why it's important that unmarried couples write a will to protect their financial future. Moving on now to allowances. There are a range of other exemptions worth taking into account to help lessen your tax bill. For example, you can give away £3,000 each tax year, inheritance tax-free. The first £3,000 given away each tax year is completely ignored as part of your estate and therefore not subject to inheritance tax if you die. If you don't give it away in 1 year, you can carry it forward 1 tax year, but no more than that, and use it then. For example, in the current tax year, you have an allowance of £3,000 that you can give away free of inheritance tax, saving you £1,200. If you didn't use that allowance last year, you can bring forward that £3,000 from last year into this year. So that's £6,000. If you're a couple, you each have that allowance. Gifts to charities and political parties are inheritance tax-free. So leaving money to the cat's home is at least tax-efficient planning. You can give £250 each year to everyone you know. So gifts of up to £250 per person each tax year are excluded from inheritance tax and are not counted towards the £3,000 annual gift exemption that we mentioned just now. For example, someone with 12 grandchildren could give each of them £250 annually as a birthday present, and it wouldn't be counted as part of their estate. However, this gift cannot be combined with other gifts on the same person. So if you've already gifted someone £3,000 annual exemption, you can't then give them another £250. You can give money away from income without having to pay tax, as long as it doesn't affect your lifestyle. Now, this is known as normal expenditure out of income, and it sounds simple enough, but actually it's quite complicated. There's definitions of what is and what isn't income that we needn't go into here. We do have a form that we can share with clients who are interested in doing this that helps them capture all of their sources of income and all of their living expenses, and it helps identify the surplus. And also, of course, we can do this through our planning services that we provide to clients. Inheritance tax is a tax on your assets, but if you have an income, for example, pension, income or earnings, and you give money regularly from that, which leaves you enough that it has not affected your lifestyle, then those gifts are exempt. Wedding gifts up to a certain limit are also tax-free. So if your son, daughter, grandchild, or anyone else is getting married, then you're able to give them gifts without it being subject to inheritance tax. There are limits to this though. So it's £5,000 per parent, £2,500 per grandparent, and £1,000 from anyone else. You need to give this gift on or shortly before the wedding or the civil partnership ceremony, and the marriage has to go ahead, or the civil partnership has to go ahead. So there are some conditions with that, but you know, these are useful allowances that everybody can use. Okay, so let's just move on then, and let's just consider for a moment that we've worked out that the value of our estate is over 325,000, and we have a liability to inheritance tax. What happens next? Okay, so some of the standard operating procedures that we adopt when we do our financial planning for people are shown here. Now, obviously, you know, this is purely insofar as the liquidation order of assets that I'm talking about just now. So, you know, we should always spend assets that generate taxable income first, then what's known as tax deferred income, and then tax free. So just to keep that really simple, you know, tax free is going to include your individual savings accounts and your pension funds. So they should always be spent last. Tax deferred might include products like investment bonds or general investment accounts, and taxable assets. Well, you know, that's going to include things like you know, savings accounts or also general investment accounts that generate taxable distributions and potentially capital gains tax. But, you know, the first basic point in terms of, you know, okay, so we've worked out we have a liability to inheritance tax. What do we do next? If you have more than sufficient income for your needs, then, you know, an obvious one is, well, you know, simply spend more money. And then, you know, if that's not acceptable to you because you don't need anything, then you could start giving money away using allowances. And one of the allowances that we use an awful lot for people in later life is gifts out of surplus income, you know, the normal expenditure allowance that we spoke about a moment or two ago. And remember that can be turned on or off, and we've seen this happen many times. So, for example, you know, someone aged 70 may have more than sufficient income and may start giving some of that away to children or grandchildren, let's say over the course of 10 years, but then from age 80, you know, may need to pay for some form of social care. And at that point, they can stop the gifts that are being made to children or grandchildren out of income and have it for their own purposes. So use of allowances is simple and straightforward. Another option is to use life assurance to pay an inheritance tax liability, and a further option is to use trusts. Now, trusts can be useful mechanisms for inheritance tax planning, either in terms of writing a life assurance policy in trust to remove it from to remove the value of that life insurance policy from the estate, or in terms of, in some situations, it's very possible to pay or to create a trust and to put money into that trust whilst still receiving some benefit from that money in terms of income, whilst having the capital of it outside of the estate for inheritance tax. And perhaps we'll look at that in the second session. It's too much for today's session, but the use of trust is always a good way of mitigating inheritance tax liability. Okay, so whilst we're on this subject, we need to just think about what constitutes a gift. And there may be some technical stuff here for which I apologise, as I did earlier. Hopefully we won't have to spend too long on this. But if we're giving assets away, we need to think about what constitutes a gift. To be effective for inheritance tax purposes, a gift must be a genuine, unconditional gift that you will not gain from in future. Something given to someone without reservation, no nods, winks, or mutual back scratching. In our view, it's always worth documenting such gifts and exchanging copies of signed letters between the donor and the recipient so that you both have records of this. For any of you that have helped children out in recent years with deposits for mortgages, then you know, a lender, a mortgage lender, will often insist that there is a letter from you know, you as donor saying that this is an outright gift and you're not expecting any of it back at any point in the future. So a letter along those lines is necessary for this purpose. And where we know about such gifts, we'll always make sure it's recorded in meeting notes and in our planning software too, because it may come into play later on. The biggest asset most people have, of course, is their house, yet trying to give half of this to your children won't work if you continue to live in it. Many gifts are a valid way of reducing your inheritance tax bill, yet if any, barring gifts on consideration of marriage, are given conditionally with the intention of receiving something in return, that gift is likely to fail to work. So do watch out, and we'll look at that in a moment or two. So we know that something is a gift and has been made from the donor to the beneficiary. Now, such gifts can take different forms. It could be a potentially exempt transfer or PET, or a chargeable lifetime transfer, CLT. It can be a gift to an individual, a PET is a gift to an individual, to an absolute trust or a bare trust, or to a disabled trust, or to what's known as an interest in possession trust or accumulation and maintenance trust, where the gift was made before 22nd of March 06. A PET, a potentially exempt transfer, only becomes chargeable to inheritance tax where the donor fails to survive 7 years from the date of the gift. In this event, the value of the failed PET, as it's known, is added to the donor's estate, along with any other gifts made by the donor in the 7 years prior to death. PETs are a complicated subject for inheritance tax planning, and advice is needed whenever you're thinking about doing this, so please do talk to us. And the difference between a PET and a chargeable lifetime transfer is very simple. A chargeable lifetime transfer is a gift to a relevant property trust. So we'll just have a quick look at an example for this. So let's pretend that Mrs. White has been making gifts of £3,000 per annum to her children for a few years. She now gives £400,000 to a discretionary trust for her children and grandchildren, but has created no other trust. As her annual gift exemption has been used, the gift is a chargeable lifetime transfer that exceeds the nil rate band of £325,000. The trustees of the trust must therefore pay inheritance tax of £15,000, calculated as £400,000 less £325,000 at 20%, because that's the rate that applies to lifetime gifts. If Mrs. White decides to pay the inheritance tax, it must be grossed up to £18,750. Suppose Mrs. White then dies 4.5 years after making the gift when the nil rate band is still 325,000. The transfer is now chargeable at 40% less the taper relief that applies to potentially exempt transfers, and with credit given for the lifetime inheritance tax already paid. The chargeable transfer on death is therefore 400,000 less the nil rate band, which gives you the excess of 75,000 at the death rate of 40%. That gives you 30,000, allowing for taper relief for 4.5 years, comes out at 12,000, with a liability on death of 30,000 less 12,000, giving you 18,000. Tax already paid being 15,000, therefore there's £3,000 payable. If Mrs. White had paid the grossed up lifetime amount of £1,750, there would be no further inheritance tax payable on death, but the excess of £750 is not reclaimable. As I said, sometimes it can be quite complicated, and in this situation, advice is necessary. What about gifts with reservation? This comes up from time to time, particularly in relation to property, where we've seen it suggested many times that couples may gift properties to children, perhaps trying to avoid that asset being counted as an asset for care fees, and sometimes they're under the misapprehension that that property is then removed from their estate for inheritance tax purposes. A gift with reservation occurs very simply where a gift is made, but the person making the gift, i.e. the donor, continues to benefit in any way from that asset. So, for example, a very simple example, a married couple own a holiday cottage, they gift it to adult children, the donors continue to enjoy holidays at the cottage and pay no rent. That would be a gift with reservation. And a gift with reservation can be avoided simply by paying rent. Okay, so look, that's a very simple example, but it helps to illustrate the point. It's also worth mentioning here that there is a relief against double inheritance tax charge on gifts with reservation. There's a possibility of 2 inheritance tax charges on the death of the donor who has made a gift with reservation of benefit. The transferred property remains in the donor's taxable estate and so is subject to inheritance tax. In addition, the lifetime transfer of value is chargeable if death occurs within 7 years. However, double charging relief ensures that there's only one charge to inheritance tax. Whichever of the 2 amounts produces the higher tax liability becomes the amount chargeable. Okay, having money in the right place at the right time is really a matter of making sure that life assurance policies are subject to appropriate trusts. Now, you don't necessarily need trusts for joint life policies. Many people will have policies written on, many couples will have policies written on their joint lives. If one of them dies, the benefit is payable to the survivor. But what if both of them die at the same time, in a car accident or something like that? Then, the older one will be considered to have died first. And so, a life assurance policy then, if it's not written in trust, would become part of the estate of the second person to die. Writing life assurance policies in trust is a relatively simple exercise. It's easier for new policies. It can be more complicated for existing policies, and there can be aspects of inheritance tax to consider if policies have a value at the date of putting the policy into trust. It's worth looking at existing policies and seeing what can be done if they're not in trust. Any new policies that we arrange will almost always be written subject to a trust. Life assurance is also useful from the point of view of protecting an inheritance tax liability. which we'll look at in a minute, and for potentially exempt transfers. And it's also worth making sure that pension death benefits, for active members of pension schemes are subject to what's known as a nomination or an expression of wish form. And it's also worth noting the importance of those and making sure that they're up to date. I saw one just this week where someone had nominated his parents, one of whom had already passed on, and was now living with his partner, yet to get married, but living with his partner. We've advised him, of course, to make sure that his nomination is up to date. How does life assurance work where there's an inheritance tax liability? Okay, so look, simple example here. Estate value £500,000. Estate value is £500,000 over the threshold. It's inheritance tax at 40% is 200,000. Yeah, there's a simple need there of life assurance of £200,000, and there's a couple of ways that you can do this. For example, you might use what's known as a whole of life policy, or you might use what's known as a term assurance policy. Taking out life assurance to pay an inheritance tax is a relatively simple exercise. There are two types of policies that can help with inheritance tax: whole of life assurance and term assurance. A whole of life policy, you specify an amount to be paid out after you die. Your beneficiaries, this policy is then written in trust, and your beneficiaries then use this lump sum to pay any inheritance tax due to HMRC. A term assurance policy is another way to insure against inheritance tax. In that situation, you either do what's known as a level term assurance, where the amount of cover stays the same throughout the term of the policy, or you do what's known as a decreasing term assurance. And a decreasing term assurance over 7 years is generally what we'd use to cover the liability in relation to a potentially exempt transfer. Now, a whole of life policy often gets quite bad press because the premiums are subject to review and they become more expensive as you get older. So typically the premiums are guaranteed for the first 10 years and then subject to reviews every 5 years thereafter. Now, what a whole of life policy does, certainly it gives you peace of mind that inheritance tax liability will be covered, but it gives you time to organise your affairs. So these policies can be quite useful as long as everybody understands that they can become more expensive in later life. All the policies can be set up on either a single life or a joint life basis. Usually, if it's done joint life, it's done on what's known as a joint life and last survivor, so it pays out on the second death, and the policies are written in a trust for the intended beneficiaries. All reasonably straightforward stuff. And of course, setting up life assurance policies involves taking a health assessment before you start. So cover can't be guaranteed until such time as all the relevant forms and paperwork has been completed and one's health has been assessed by the insurers. If you're thinking about taking out insurance to cover an inheritance tax liability, it may be helpful to think of it as effectively paying the inheritance tax bill yourself in the form of life assurance premiums. Most of the time, those insurance premiums will be will fall within the normal expenditure out of income. And it's important to make sure that the policy is written in trust, so that because writing the policy in trust removes the value of the policy in terms of its claim value from the estate for inheritance tax purposes. And just a final point on this, taking out the insurance doesn't reduce the inheritance tax due on the estate. it's simply a way of paying the inheritance tax bill. So look, it does give you peace of mind that the IHT will be paid and that the money will be in the right place at the right time. But alongside the life assurance, it's really, really important that you take steps to organise your affairs, you know, and use allowances and use gifting where possible to help mitigate that tax. Because certainly, you know, with a whole of life assurance policy, there could come a time when it's simply unaffordable. That's unlikely to be the case with a term assurance policy that runs for, you know, 10 or 20 years for a known premium for that period, and then it stops. You know, with a term assurance policy, I suppose, you know, one knows that you have a finite term in which to sort your affairs out. Okay, so as financial planners, you know, we need to think about pensions a lot. A lot of our clients will have pensions and will have pension funds managed by expert wealth. Now, remember, we're talking here about what are known as defined contribution pensions. So these are funds of money, so personal pensions, self-invested personal pensions, things like that. We're not talking about what are known as defined benefit or final salary pension schemes, you know, examples of which would be, say, the NHS pension scheme or the university's pension scheme. We're not really talking about those here. Those aren't really, you know, there's no fund of money that is part of the estate for inheritance tax purposes. If we just think of this as a pot of money with a pension, you know, within a pension wrapper, pensions are normally exempt from inheritance tax, but there can be some situations that can give rise to inheritance tax. So it's worth spending a few minutes talking about this. For example, contributions, you know, you make a contribution to a pension plan, that's out of normal expenditure out of income. That's normally immediately outside of the payer's estate, unless the person is considered to be in health or is perhaps making contributions to someone else's pension plan. If the contributions are made whilst the member is in good health, then there should be no what's known as transfer of value. That term will come up again later on. But if made whilst the member is in ill health, there may be a transfer of value. And that transfer of value is the bit that can be brought within the inheritance tax liability. The underlying principle, though, is that where the member is likely to survive to take their retirement benefits, then payments are for their own benefit and so are not considered to be transfers of value. It's accepted practice that contributions made more than 2 years prior to death are not transfers of value. Pension death benefits can also be subject to inheritance tax if the estate has a legal right to payment, which could be the case with some old-style pension plans, such as retirement annuities or so-called Section 32 buyout policies. And particular care should be taken for pension transfers. And it doesn't matter from where the pension is coming from or going to. Any form of pension transfer, even, for example, a pension drawdown to a pension drawdown with another provider, you know, care needs to be taken, particularly if the member is in ill health at the date of transfer. There is this so-called 2-year rule, whereby if the member dies within 2 years of the transfer from a pre-existing condition, it is possible that HMRC will seek to include the transfer of value in the member's estate. We'll come back to that in a moment or two. On the subject of contributions, it is just worth looking at this, which comes up from time to time. So here we look at a situation where grandma pays into little Johnny's pension for him. We're assuming that grandma is using her annual £3,000 allowance, and Johnny uses this money that he receives as a net contribution to his personal pension. So he pays £3,000 to his pension provider. Basic rate tax relief is claimed by them, added to the pot at 20% or £750. In fact, Johnny's a higher rate taxpayer, and so he claims a further 20% tax relief through his self-assessment return. In that situation, total family tax relief works out at 90%. So that's a highly tax efficient arrangement. assuming grandma can afford it and assuming little Johnny's got sufficient pension allowances and so forth. What I would say in terms of adding to this is, look, there may be other things that can be done here. Little Johnny may be a higher rate taxpayer, but buying a house might be more important to him. All sorts of other things that can be going on. But it is just useful to look, although it may be pushing the point a little, but it shows you the possibilities of a grandparent using allowances to help pass wealth on to future generations. Okay, so continuing the theme about pensions and inheritance tax, there are three areas where pension funds could be subject to inheritance tax, one of which is beyond the scope of this session, so I'm going to ignore that for now. That really does get quite technical, so it's best ignored. But we'll talk about the sort of more common things that come up here. We need to think about payments that form part of the estate, part of the death estate, where the member's estate has a legal entitlement to have the value of the death benefit paid to it. Okay, so think about there, if the member's estate has a legal entitlement to the value of a plan to be paid into the estate, then that death benefit in that situation clearly becomes part of the member's estate. This can arise, for example, where an old, what's known as a retirement annuity contract, these are basically personal pensions that existed before July 88. Some of those had such clauses, contract terms is the words I'm looking for, that did not allow those plans to be written subject to a trust. In that situation, the benefits could be paid into the estate. And also I mentioned earlier, something called a Section 32 buyout plan. Those such plans do exist. There's many thousands of those still around. They can be set up so that any death benefits paid prior to retirement are paid to the member's estate. So if anybody does have old retirement annuity contracts or Section 32 contracts, they definitely need looking at. And also any outstanding guaranteed payments from an annuity that are may be payable to the estate or paid at the annuitant's direction will be included. And any arrears of annuity payable to the estate for whatever reason. So there are certain aspects that can come into the estate. But the more common area that we see is in relation to pension transfers that we talked about a moment ago. So I do need just to go into a little bit of detail on this. HMRC considered transfers of benefits from one scheme to another to be a transfer of value. This is down to the fact that the member could direct that the transfer is made to an arrangement where the estate would be entitled to the death benefit. Like most other things, the good health and 2-year rule applies, but this is a grey area and there's an absence of case law to give an idea of what any transfer of value will be. HMRC will review each case individually, taking into account its specific circumstances. And a transfer of value could be nominal, it could be exempt, but it equally could be substantial. The basis for calculation is the loss to the transferor's estate. In broad terms, the transfer of value is the difference in value of the death benefit and the retirement benefit in the receiving scheme. Finally, whilst the member retains the right to retirement benefits, there are no gift with reservation rules. You may be thinking about this from earlier on. No gift with reservation issues that would arise normally when gifts are made and an entitlement to benefit from the gift remains. So pension funds are not subject to gift with reservation rules, but they could be subject to transfer of value in the event that a transfer takes place within 2 years of the member dying. So care is required. What about pension drawdown? You know, a lot of our clients, a lot of you will be retired and in receipt of benefits from your plans. These are known as you know, pension drawdown plans, where you have a pot of money and you take money out of it either regularly or as lump sums during the course of a year. Again, the normal rule is that pension funds are not part of the estate for inheritance tax purposes. But there are some circumstances where this can come into play. For example, if you reduce or suspend income payments, then you know, the 2-year rule can come into play. It's also worth mentioning here that the simple rules of pensions now, there is this cliff edge scenario around age 75. If you die before age 75, the pension fund can pass as pension fund to your nominated beneficiary or beneficiaries entirely tax-free, provided it's done within 2 years of the member's death. And of course, there's going to be a lifetime allowance test at that time. Now, the beneficiary receiving, let's just say there's one beneficiary receiving that pension fund, if the original member had died before age 75, the beneficiary receiving that pension fund can then take benefits from it entirely free of income tax, whether that's as a lump sum or as an income. And then if the recipient then dies before age 75, his or her beneficiaries can take income or lump sums from that pension fund entirely tax-free. So the cliff edge scenario revolves around the age 75. Post age 75, member dies, benefits paid to a nominated beneficiary are taxed as income tax. Okay, so the whole point is around the age 75. Death before age 75, benefits received tax-free by beneficiaries. Death after age 75, benefits received as taxable income by beneficiaries. Okay, so let's just say that Joe dies post age 75 and his wife is much younger. Let's say she's 65. So Joe dies, leaves his fund to his wife. She receives that fund and draws an income. She pays tax on it. She then dies at age 70 and the residual fund is left to, let's say, Dave and Sally, their children, 50-50. So because Joe's wife has died below age 75, Dave and Sally can then take their benefits tax-free. Okay, so the whole point is around this cliff edge scenario at 75. And just a final point here about the importance of nomination forms. It is worthwhile checking that nomination forms are up to date and accurate. Without a nomination form, you can run into complications of what options are available to beneficiaries in the event of someone dying with a drawdown pension fund. So, you know, we'll always encourage you to make sure that nomination forms are up to date. Now, some of you may have heard and read about in the press and so forth about so-called bypass trusts. These used to be known in our little world as spousal bypass trusts. And this is basically a mechanism whereby someone with a pension fund would nominate a trust to receive the fund value in the event of their death. The idea being that it gives the pension fund owner some control over the ultimate direction of pension funds even after they're gone. Although having said that, of course, the trustees of the trust have the final discretion and make the final decision about where the money goes. Now, the tax treatment where there is a bypass trust in place is slightly different. So in that situation, you have a pension fund member dies and a lump sum death benefit, the LSDB on the slide here, the lump sum death benefit is paid to the trust subject to a 45% tax charge. But then the trustees then pay the tax to an individual or to individuals. And at that point, it's taxed as income, but the recipient can offset the 45% tax that's already been paid. So the intention, although the mechanism might not be quite there, the intention is that the tax treatment of benefits paid through a bypass trust is the same as shown on the previous slide. It's just a bit more complicated. Our view now is that bypass trusts really only have one benefit, which is probably to protect family assets in the bloodline and prevent it being attacked, if that's the right word. It probably isn't, but I'll use that for the moment, in the event of children getting divorced or something like that. It's something to talk about with us on a one-to-one basis if it applies to you. Okay, so just moving into the final couple of slides now, and the in case of emergency document, the ICE document that we sent round to everybody recently, that we're encouraging you to do, is available on our website. Don't know whether this link is going to work and bring it up. Yes, okay, so it's available on our website under the resources and guides section, and you scroll down and there's the in case of emergency document that you can click on, and here it is here, and this enables you to complete a lot of information about you, your situation, what you want to happen in the event of dying, names and address of providers and so forth, other professionals that you're in contact with, details of your social media accounts, all sorts of stuff. And there's a section for free format notes. Now, what we're encouraging people to do is to complete that, make sure it's saved somewhere safe. You can upload it to the client portal if you want to, as a secure document storage area. And we'll be able to see that in the event that catastrophe happens. But this is something that's freely available from us. And if anyone has any suggestions on how we can improve it, please do let us know. It's good. It might not be perfect, so do come back to us with suggestions and we'll do our best to incorporate those. Okay, so that's it from me for this time. Thank you very much for listening. I hope you found that useful. As I said at the start, we'll move on to questions in a moment or two. A date for your diary, though, we're going to do the second part of this next time. So that's the 24th of August at 3 o'clock. We'll send around an invite in due course. And the things that we're going to cover at that point, simple steps you can take to save inheritance tax. Gifts out of surplus income, we'll look at that in a bit more detail because that's a really interesting thing to chat through. Well, at least it's interesting for us. I hope you find it interesting. What happens if you give some of your estate to charity? Larger gifts using trust, and some income strategies that you can use to save inheritance tax. And we'll have some, hopefully we'll have some worked examples there that we can show you. Otherwise, let's move on to questions. So thank you very much for your attention. That's it from me. I'm going to have a cup of tea, but I'll be here to answer your questions with John and Rachel as necessary.
Well, thank you first of all to Dom for putting that together. I know he spent an awful lot of time on it, and the balance always is to give you enough detail that you need to sort of understand these things and start to give some thoughts. And even if it is just triggering, picking up that phone and talking to us, obviously we will pick up the detail as necessary. But the balance always is between giving you enough information and making it over complex. So hopefully Dom sort of struck the balance perfectly well there. I particularly like, is something we've put together recently, is that in case of emergency document, because sometimes people sit there and think, well, how would my loved ones know where everything is? And what we've tried to do with that is say, if we have one document where even if it's just a basic details, even if it's just, here's my phone number of my financial planner, phone them, they'll know where everything is, or most of their stuff is. that in itself is of value for your loved ones trying to pick up the pieces, which at the end of the day is going to be a very upsetting time for them if they've just lost you. We have had a few questions in, and please do put any more questions in the Q&A if there's anything you've thought of, anything you'd like to ask that's not too personal. Please put it in the Q&A and we'll be able to pick it up. If you've got any private questions that you'd rather speak to us one-to-one, then obviously pick up the phone to us and we can run through these. So here's one question. If me, my children, or anyone I know died intestate, in other words, they don't have a will, and they're married, will my spouse only get the £270,000? Well, in theory, that is correct. Yes, they will only get £270,000. Like all these things, it's not quite that simple. For example, if you owned a house together worth £500,000, would they only get £270,000 worth of it? Well, the answer to that really depends on how you've bought the house. In most cases in this country, most solicitors for married couples, often couples that are not married, is they'll buy the house as joint tenancy. In other words, both people own the whole house. So on death, the other half of the house automatically transfers to the other person outside the will, outside the rules of intestacy. So the 270,000 effectively would be in addition to that house. If they own a house, tenants in common, they actually own separately those shares in the house, and that would have to be dealt with via a will or something through the intestacy rules. So you do need to be a little bit careful on that one. Second question was, if I made pension contributions quite close to my death, i.e. within this 2 years that Don made, would they be outside my estate or inside my estate? Well, if you'd clearly known you were about to die and you suddenly decided to put lots of money into your pension, the Capital Taxes Office wouldn't actually look very kindly on that, because they would say you're deliberately planning to avoid inheritance tax. And the likelihood is that they would pull those contributions back into your estate. However, let me give you one example of one of my clients who died a few years ago. We were doing normal planning. We were talking about future. He'd finished all his major expenditure and it was catch-up time for his pension. So in other words, he wanted to really fund his pension. So what he did was, through that planning, we put quite a chunk in, about £100,000 into his pension. A few months after that, basically, he discovered that he had terminal cancer and died within 6 months. So literally within a short period of time of his death, he was basically suddenly found that he had put money into his pension. Did that get pulled back by Capital Taxes Office? Well, actually, it didn't, because what we did for his children, we basically provided him with all the meeting notes that we'd put together to show that he was incomplete. We weren't at all aware of his ill health at the time when we were doing the planning. And the Capital Taxes Office accepted that was genuine planning. It wasn't simply planning to avoid inheritance tax. So those were actually allowed. So it doesn't always follow that basically if you do something and it falls in one of these rules, that it actually applies in a certain way. They do look very sensibly at these situations. So if you are genuinely planning with genuine advice, often they will accept a situation in those circumstances. Final question we had was, are all pensions potentially subject to, all pensions subject to being potentially inside your estate? The truth of the matter is, vast majority of pensions that we deal with, that we have you in, that we've advised you to go in, are very modern pensions that are protected by their own trust. So they're written under proper pension rules, proper trust rules, etc., etc. So vast majority of those are completely outside your estate should something happen to you. So there would be no need to worry about those. The ones we were talking about in the seminar were more old style pensions that often were not written under trust. and did fall back into your estate. Now, normally, if we've identified those in the process of planning and advising you, we would understand those pensions, whether they fall into or not into the estate, and we more than likely would have had that discussion with you. But it's always worth checking, because sometimes people have smaller old pension pots around that they're not, that they haven't really sometimes even told us about, that could fall under this old sort of legislation where those pension pots, even though we all understand pension pots shouldn't fall inside the estate, there are some types that do actually fall into the state. I'm just going to check if we've had any other questions.
One from Gordon Child, which I've just answered.
Okay, I think we've had one from Gordon, which I think we've been answered on the forum. Well, hopefully you found that helpful. Again, thank you once again to Dom and Rachel. I know they spent a lot of time putting that presentation together. Next time we're going to be looking at more into the sort of planning strategies that one can take when trying to mitigate inheritance tax. In other words, you know you've got an inheritance tax issue, you know you might have to pay inheritance tax at some point, but what planning strategies can we put in place to ensure that you mitigate that as much as we can? So we'll certainly be looking at things like using of trusts and how you can use those, how you can draw your income down in certain ways to ensure that you maximize your allowances and everything, so you don't pay excess inheritance tax. And also to talk about how you might pass on your estate, some of your estate, via your pension fund, which we sort of touched on briefly. So there's going to be a lot more talking more about the practical things that we can do potentially, or a way we might be able to help you in terms of help mitigating those inheritance tax. So once again, thank you for attending. Thank you for staying with us. And look forward to seeing you next time. I believe the invite did go out today or yesterday for the next seminar. So please sign up to that. Please join us again in a couple of weeks' time. Thank you very much.